Every single day, you're hit with financial headlines. Invest now! Don't invest, a crash is coming. Buy stocks. Buy gold. AI is a bubble. So who's right? Here's the truth no one tells you. The reason most people never build wealth isn't because they make bad investments. It's because they're paralyzed by noise. Today, I'm going to cut through all of it and show you a simple, proven investing strategy that actually works without jargon, without hype, and without guessing. This video is about the stock market for beginners, a simple investing plan that works. Let's start with the basics. Investing is simply using your money to make more money. That's it. So why does this matter so much? Because of inflation. Inflation quietly steals from you every single year. If you leave $1,000 sitting in your bank account, it feels safe. But in a few years, that same money buys you less food, less fuel, and less freedom. Doing nothing feels safe, but it's actually the slowest way to lose money. The second reason investing matters is this. In today's economy, owning assets is rewarded far more than just earning a salary. People who bought property years ago saw their wealth double. People who invested in the stock market earned around 8 to 10% per year long term. But salaries? They barely keep up. If you feel like you're stuck in a loop of earning, spending, and starting over, investing is how you break that cycle. When you buy a stock, you're not gambling. You're buying a small piece of a real business. If you buy a share of a company, you're saying, I believe this business will grow over time, and I want to grow with it. Stocks are traded on the stock market, which is simply a marketplace. Prices go up and down based on what people believe companies are worth. There are only two ways you make money here. First, you buy a stock and its price goes up. You sell it later for more than you paid. Second, dividends. Some companies share their profits by paying investors regularly, just for owning the stock. Simple, but here's where most people go wrong. They try to pick the perfect company. Even the biggest companies can fail. At one point, everyone thought BlackBerry was unstoppable. Today, that stock is worth a fraction of its peak. That's why most successful investors don't try to guess winners. Instead, they look at various companies, analyze their financials, understand their business models, etc., and they diversify by buying small pieces of those great companies. This is where index funds come in. An index fund is a basket of hundreds or even thousands of companies. When you invest in something like the S&P 500, you're investing in the largest companies across multiple industries: technology, healthcare, finance, energy, all at once. Over the long term, this approach has returned around 10% per year before inflation. Instead of betting on one company, you benefit from the growth of the entire economy. And here's the key. The biggest companies today won't always be the biggest tomorrow. History proves this again and again. Diversification protects you from being wrong. And in investing, everyone is wrong sometimes. Now you are asking yourself how to start. Step by step. Starting is simpler than most people think. First, choose a regulated investment platform with low fees. Fees matter more than most people realize. When choosing an investment platform, what matters most is that it's regulated, reputable, and low cost. In Canada, some popular beginner-friendly options include Questrade, Wealthsimple, and Moomoo. I'm not saying one is better than the others. The right platform is simply the one you're comfortable using and can stick with long term. Second, use tax-advantaged accounts if available, like a TFSA, RRSP, or employer pension matching, etc. Third, start with diversified index funds instead of individual stocks. And here's the most important step most people ignore: automation. Set up automatic monthly investing. $100, $200, whatever you can manage consistently. This strategy is called dollar cost averaging. You invest through good markets and bad markets, and over time, it smooths out the risk. Most importantly, it removes emotion. What if the market crashes? This is the question everyone asks. Yes, markets crash. They always have. But here's the truth. The biggest danger isn't the market, it's you. Panic selling during fear destroys more wealth than any crash ever has. Buy more share during crashes instead of panic selling. When you're diversified and automated, crashes become temporary, not permanent. If you've been waiting for the perfect time to invest, this is your sign. Stop listening to the noise. Build a simple plan and stick to it. That's how real wealth is built, quietly, patiently, and over time. Thanks for watching. If you're ready to build real wealth, take control of your money, and unlock financial freedom, make sure to like, comment, and subscribe. You should join a community focused on smarter money habits, real strategies, and life-changing financial insights.